stock market manipulation. Again, just for the recording, Jack will be covering how to profit from legal stock market manipulation. And with that, Jack, I will let you take it away.
All right. How's everybody doing this morning? Type it in there if you can hear me and see me okay in the chat. And then I want you to type in some questions after I tell you about this crazy thing. Hey, Tim, Christopher, Joseph. All right, Philip, doing well, Terry. Okay. So a long time ago, I don't know, 20 some years ago, I stumbled upon a crazy fact in the market and how much the index is manipulated. And what the S&P 500 does is it changes the makeup of the index all the time. So the S&P 500 we're looking at today is not the same S&P 500 we were looking at 5 or 10 years ago or even 2 years ago. So when we look at a chart on the S&P 500, it does tell us what the broad market is doing, but it doesn't tell us what the same broad market has been doing. And the reason the S&P does this rebalancing is so that the S&P as an index is always relative to the best stocks in the market. Now, most people don't know this, and most people are totally unaware of this, which is why I really want you to pay attention and write this down, is that the S&P 500 index is totally manipulated, legally manipulated. So is the Dow Jones, but there's only 30 stocks in the Dow Jones, so it doesn't get as manipulated as the S&P 500, which is kind of a crazy thing because when, like I say, when you look back at the S&P 500, you can see the chart, but it's not a chart of the same stocks in the index. And the reason for that is because, like I say, they want the index to be relative, and how they keep it relative is very simple. They kick out the stocks out of the index, stocks that are not performing well, and they add stocks that are performing well to the index. So you can see just from my explanation right there how it is we're not looking at the same stocks in the index. It's constantly evolving, changing. They call it a rebalancing. That's just a nice word for manipulating. So, they'll kick stocks out. And what's ironic also about this is all the hedge funds and institutions that manage money, they want to use the S&P 500 index as a benchmark for them to beat. But the irony of that is they all own the same stocks. And when the S&P 500 kicks a stock out of the index, all the hedge funds and institutions that own that stock, they sell it because it's no longer relevant. And all that selling pressure drives down the price of a stock they kick out of the index. And this is all public information. You can research if you want, but I've already done it. And the fact of the matter is, when the S&P kicks a stock out, that stock goes down because all the institutions and hedge funds are selling it. And when a stock gets added to the S&P 500, they buy the same stock. So when a stock gets added, it goes up in price. And sometimes you could find this out well ahead of time when you just find a little research or even Google, when is the S&P 500 rebalance? DA's got a link for you to give you to tell you when that's going to happen. But the irony of it is, like I say, yeah, Doug said, I remember when Tesla was added. Yeah, totally. The stock went up for no reason other than because it was in the index, and all the other funds that want to mirror or try to slightly beat the S&P 500, they buy the stock. But why the hedge funds and institutions want to own the same stocks in the S&P 500 when they're trying to beat the S&P 500, to me, is ridiculous. The same thing when we look at insider and hedge fund buying. You look at which hedge funds own which stocks, and you look at Johnson & Johnson, for example. You got 168 out of the 200 funds tracking that own it. I mean, like they all own the same stocks. That's why you rarely see any difference in these funds. And if you're ever wealthy enough to where you want to hire a manager, don't do it, because you can do better than any manager out there doing it on your own. And there's no reason to pay any fee to any manager, regardless of his track record. I don't even think you should pay the fee to be in an ETF, which is only sometimes 0.8%, but you still don't need to pay anybody for anything in the market. You can make all your moves yourself. Most of them are commission free. So you got that. But the way you can profit from this illegal or this legal market manipulation is just front run the stocks that they're adding and buy those or buy a call on those, and either short or buy a put on the stocks they're kicking out. And if you can do that right ahead of time, then you're good to go. But even if you find out about it on that same day that they're doing it, it's still a good trade. So in this link DA has for you, he's got all the stats, and we'll give you that. It's kind of like a playbook on how to profit from this, but it's a really weird thing. It's probably the closest thing to guaranteed trade profit in the market that I know of. And it's repeatable, and you can find out about it. Nobody pays attention to it except the top tier guys. Like the average trader, they have no clue what's going on with the S&P 500 or how this quote unquote rebalancing affects what the index is. But it's a complete manipulation in the fact that, like I say, the S&P we're looking at today is not the same one we were looking at even 2 years ago. So that you've got a built-in edge when you know ahead of time what the index is going to do. And even though they call it a rebalancing, that's kind of a funny word, because it's not a rebalancing. It's strictly, let's kick out the stocks that aren't doing well and let's add the stocks that are doing well. So our index is always relative and mirroring the stocks that are doing real well. So how frequently do they rebalance? That I don't know, but you can go to this link and have it pop up, or do a search whenever there's a rebalance. You can find those stocks. They name and list the stocks, and most of the ones they kick out, they're already dogs. So sometimes on the downside, it's not always as good. I've tried buying the ones they added and selling or shorting the ones they kicked out. And the kick out is okay, but it's not as good as the ones they add, because usually the ones they kick out, like I say, they're already doing poorly as a stock performance. So there's not much more downside to it. Yeah. And so, one thing we talk about a lot in this rebalance and is dividends and things like that. And I'll give you one example, 3M, MMM. It's a lot of people love it for a dividend stock, but it's a dying business. The company is dying. It's on its deathbed. And you can look at that and tell that in any stock by looking at a 5-year trend or the maximum trend. And if you pull up MMM and you look at a 5-year chart on that, it's terrible. And that's an example of a dying business. So there's not always a lot more downside on those when they're on their deathbed. But when they add a stock, which you can find out ahead of time, that's the closest thing I know to a guaranteed trade. And in reality, there's nothing guaranteed in the stock market. Anything can and will happen. But this is an event that when it does happen, you should take advantage of it, because like I say, it's pure manipulation. It's open to the public. They don't want to call it manipulation, but that's exactly what it is. So pay attention to this, and we'll give you this link that we'll give you the link and the little report that I wrote a long time ago when I first stumbled upon this, and it worked really well for me. I think it'll work really well for you too. So just if you can pay attention to that, DA will drop that link in there. So now let me look at a chat. I think we can find out how often they do the rebalance. I just haven't checked on that. Joseph, we have the recordings on all of these weekly spreads, they're all at jackcartertrading.com. Yeah, we should look up when that rebalance is.
Hey, Jack, I believe the S&P is throughout the year. I don't think it's at any set particular time. What I do is I keep an eye on the page where they put out their press releases, and that link will be in the report. I'll post that report towards the end of the show.
Yeah. And, the other thing about it is the rebalancing thing on the additions is rumor. You can get that way ahead of time when you start to read from the top writers that a particular stock could be or is about to be added to the S&P 500. That's probably a good bet. It's no secret what they do. It's just a secret that it's manipulation. All right, DA has the link there for you, Joseph, for the weekly spread. We got all the recordings on there as well. Yeah, Leslie, we'll put them up at the website. It's crazy, isn't it? I mean, the Dow does it, but not as often. And like I say, there's only 30 stocks in it. So the best play is on the S&P 500 rebalance. Yeah, and there might have been one just several weeks ago, Cindy, but there's always going to be new ones coming up. And now you know the trick, right? So you can just front run what they add. And I would probably buy it before they added it and maybe sell it a day or so after they add it or whenever it stops going up. But if you buy it before they add it and you make a couple, $2-3, whatever, look really to start selling, right? Just you don't want to, no one can buy at the bottom and sell at the top. And anybody that tells you they can is blowing smoke up your skirt. I never buy at the bottom and I never sell at the top. And I don't care because I just want a little piece of the trend. That's all that is. So if you front run it, they add it, it pops, get rid of it. Yeah. I did say, excuse me, I did say this legal stock market manipulation is the closest thing to a sure thing I've ever seen in the market. Yeah, that's true. The first time I saw it, it kind of was amazing because it flies below the radar. They put out a press release on it, but there's really no explanation or talking about why they add or drop a stock. They'll drop a stock because they don't want it to pull down the S&P 500. That's really the bottom line on that is they don't want any one or two stocks dragging the entire index down when it could be taken off if they've got the right ones in there. So to me, the whole thing is just a big joke that they manipulate the market and hedge funds manipulate it right along with them. And they're still trying to beat the index that they're participating in the manipulation of. So it's just one big joke. And I wouldn't pay too much attention to any of this other than during that rebalance process. Otherwise, we just use the S&P 500 to gauge what the broad market is doing. And to do that, you just go to your chart in your brokerage account, or you can even do this on Google or Yahoo Finance. You just type in SPY. That's the ETF that tracks the S&P 500. And you can look at that in a 6-month chart, and you can just tell without any technical analysis, is this going up, down, or sideways? And then if you want to lay a little technical analysis on there, you could put some moving averages or RSI or whatever you're comfortable with. But even without any technical analysis, just pulling up a 6-month chart of the SPY will tell you the direction and the trend. Same thing with DIA. That's the ETF that tracks the Dow Jones, and QQQ is the tech heavy NASDAQ. But the big move, the biggest play that I've seen is in the S&P 500. So lay some more questions on me.
Hey, Jack, here's a question for you. Um, you've talked about the S&P. I believe that I read in your report the only other index that announces in advance that there's going to be a rebalancing is the Russell. Is that true?
That is, I haven't tracked anything with the Russell 2000. Those are smaller cap stocks, and the difference is that the hedge funds and the institutions, they don't use the Russell as a benchmark to try to beat. They only use the S&P 500. Is that Billy Wags? Are you saying, what about using FinViz? I think that's what you're saying. What about using FinViz? FINVIS? I don't know if FinViz. So Philip Lee, I find the stocks about to be added when the S&P says they're going to add them, or when I hear any chatter through the financial media that a stock is about to be added. Like before Tesla got added, it was all over the place that it was going to be added, right? And then it did. Yeah, FinViz is a scanner. S&P news release is great too, Philip. I don't know if FinViz, I haven't used FinViz, Cindy or Billy Wags. I know a lot of people do. I don't use it. I use a software called TrendPoint. That's all I use. And then from there, I do the rest myself. So you can look at S&P news releases, or you'll find it if you just look at financial news, you'll see it. And DA, what about dropping that link in that report in the chat?
Will do. Give me just one moment and I will drop that in the chat.
So the link DA has will solve all your problems. You just watch this. You know how to, guys know how to bookmark a link in your browser? So when you get this one from DA, just bookmark it and take a peep at it every now and then, or you'll see it in the news. All right. So we got the report, and in the report is the link. So go to jackcartertrading.com/legal manipulation. It's free. It's a pretty good read. When I first wrote that, I don't know when I wrote that, DA. It might have been 10 or more years ago. But when people looked at that headline, how to profit from legal stock market manipulation, it really opened a lot of eyes, and really shocked and surprised a lot of people that knew nothing about it. And it's just so funny how, people don't realize that this happens. Yeah, sometimes the index itself won't move. Charlie says, for your information, was watching NASDAQ rebalance over the summer and played for an increase in QQQ, nothing. Seemed like the index folks had already priced in the changes. Yeah, one stock won't change the QQQ, or even two. It won't change it'll change the makeup of the index, but it won't change how the index is going to move right when they add or drop a stock. All right, yeah. So DA saying, there's a link to the Standard & Poor's press release page. That's the one you should bookmark in your browser. All right, we got another link up in there if that one didn't work. All right, here's a kind of an unrelated question to what we're talking about with the manipulation, but Donna brings up a good question. Donna says, I really struggle with staying in a trade on days like today with gaps down, moving down on open. I use moving averages, and when it's below the 50, I get out. That's good. So I got out of the weekly options trade this morning when it dropped below the tripwire, but now I see it's holding above that line. So I probably panicked and got out too soon. Not sure how to manage these, especially short-term trades that crash the day before the expiration date. What should I be watching to think about it will close out of the money? That's a really good question. So we got this AVGO trade on. I wouldn't get nervous about it. I wouldn't get emotional about it. Scott says, yeah, getting nervous. Don't be nervous. It's simply A or B. You're going to get out or you're going to stay in, but there's no nerves. And, I wouldn't panic. So what I do is I do two things. I tell people if it hits the tripwire to get out of the trade. That's the simplest thing for people that don't want to let the thing progress out. So I wait until right before the close on Friday. Now, AVGO is down today. And what I'm going to do is I'm going to wait until tomorrow, like about 10 minutes before the close. If it gets close, if it doesn't get close, I'm just going to buy back the short put. If it gets trapped in between trend points, then I'm going to cover the short leg and stay long the long leg, thinking if AVGO goes down some more. But the other thing you got to realize too is we were so far out of the money on this AVGO trade to start with that I'm going to let that premise of us being way out of the money in AVGO staying above our short leg. I'm going to let that ride, because there's three options on a credit spread for getting out. One is do nothing if you think the options are going to expire out of the money on expiration date. I still believe that with AVGO. The second thing is to just simply unwind the trade if the underlying stock hits the tripwire. And the third thing is if you think the stock is going to go below both strikes, then you would close out, you'd buy to close the short leg of the credit spread, and you'd stay long the long leg. Now you're going to lose money when you buy to close the short leg. You're going to take a loss on that. And if the stock keeps dropping and you stay long the long leg, you possibly could make up for what you lost and have a huge profit. The biggest profit we ever had in a credit spread was when the trade went bad. How funny is that? So one of the members, he made $13,000 on a trade that he only went in to make $1,000 on with his net credit. So no, I'm not going to roll to the next week, Les. I never ever do that. I don't roll options out. The only time I roll an option out is if I buy back a covered call because I don't want to get called out at that strike price. Then I will buy back that covered call and then sell another one at a higher strike price that's going to expire 30 days out. So I don't roll out to the next week. Now, Les, the reason I don't roll out to the next week on the exact same stock, and this is a great question, is because when this stock is down like it is, this move on AVGO, if the trend is broken, then I'm definitely not going to roll it back out. If the trend is not broken, then I'm just going to let my trade expire worthless on that Friday and then either pick the same stock the next Tuesday or find a new stock. So why would stocks that are added to the index typically see a price increase? That's strictly and simply because all the hedge funds and institutions are buying the stock at the same time because it got added to the index. And how you can protect your investments trading based on this strategy, there's not a whole lot to protect. Once you're in the stock, it's a short-term trade, not even a week, right? A couple of days, maybe a day, three days, 4 days. So there's not much protection you need there, but you could sell a call against the stock you bought, or a real great strategy. But the ones in the S&P, they're not all that volatile. But if you really want to protect your investment on any trade, and you could do this now on any stocks you have, let's say you buy a stock that's getting added to the S&P 500, and let's say that stock is trading at $50 a share. Well, the single best way you can protect yourself, you buy a stock at $50 on any trade, not even related to this rebalance trade. But if you got a volatile stock that you go long, and you buy that stock at $50 per share, you want to buy a $50 strike price put on that exact same stock that's going to expire in about 30 to 40 days. That means if you buy the stock at 50, and let's say you pay $2 for the put, right? Now, if the stock goes below 50, that put that you bought is going to start going higher and higher and higher in value, right? So if the stock goes up from 50, the money you spent on the put, you're buying insurance. You're going to write that off. If the stock goes up past 52, then you start making money because you bought the stock at 50 and you bought a 50 strike price put for 2. So now if the stock goes over 52, it's taking care of the $2 you spent on the put to buy that insurance at $50, right? You paid 50, you bought a put at 50, you bought the right to put the stock for the exact same price you paid for it. That's the best insurance you could get on any investment. And there's no lesser known indexes that do this as well, because they don't have the following of the hedge funds and institutions in the index. The S&P 500 is the benchmark for all hedge funds and institutional players. They don't use other indexes to use as a benchmark. So there's no experience of significant price movement during rebalancing of other indexes.
Hey, Jack, can I jump in for a quick moment?
Sure.
I just want to cover a very, very recent example. And when I say recent, I mean less than 1 week ago. This was Friday, September 1st. I'm looking at the S&P press releases page right now. It says Blackstone and Airbnb set to join S&P 500, others to join S&P 100, blah, blah, blah. So the announcement inside says that as of September 18th, Airbnb will be added to the S&P 500. Now, that announcement was made on September 1st, Friday. I'm looking at a chart of Airbnb right now, stock ticker ABNB, and the ticker's trading flat on Friday, and probably right when the release came out, right at 5 p.m., you see the thing jump 5.9% instantly, probably within, let's see, looks like about an hour, 90 minutes, something like that.
You go.
So that is just, for people that are still incredulous about how this works.
Yeah, don't doubt it. It's a fact. It's just a fact that flew below the radar till your boy Jack uncovered it and wrote about it. And since then it's been something people look at. But you're right, DA, within an hour. Now here's something. You said that was at 5 o'clock. So that's an hour after the market closes. Okay. But here's a little trick for you. If you go to, I know Schwab does this and most other brokers do this. They have a session called the after hours session. And what that is that's where you can trade in the stock market after hours. And it's real cowboy days in there because there's no market makers, right? Now, the market makers, they kind of set the tone for how a stock is going to trade. And remember, they don't care if a stock goes up or goes down, contrary to what the public thinks. Market makers could care less what the price of a stock is. They don't care if it goes up. They don't care if it goes down. What they care about is only one thing, and that is at what price does the stock yield the most buy and sell volume? Because they make their money on the difference between the pennies between the buying and the selling. So when they find that perfect price, that's where the stock will yield the most volume, and that's what they want. They don't care about the price move. Now, when they're out of the market in the after-hours session, there's no more of that, participation of the market makers where they're willing to buy at the bid and sell at the ask. So what you could see is a stock gets added to the S&P 500. That comes out at 5 o'clock on Friday, or not Friday, 5 o'clock, whatever. You go into the after hours market, you could buy that stock right the minute it gets announced. And you can sometimes, I've done this a billion times, just put it out there at a price way higher than you paid for it and watch it trade up to your level. That's one thing. The second thing you could do is right when the announcement happens after hours, you buy it after hours at whatever price you could get it, and then you sell it market on open the following morning. That's really good too. But sometimes the best play is in the after hours, and sometimes the best play is in the next day. Now, the last time I played an after hours trade was on NVIDIA. I bought the stock at 468 on the day of earnings last week or whatever. And at 420, 20 minutes after the close, they announced earnings and the stock popped. If you watched it in the after hours, you wouldn't believe it. It went from 468 to like 470 to 480. I threw mine out there at 505 when the stock was trading at 480, and within 10 seconds, I got filled at 505 from 468. I also bought some options, some 470 strike price options. And the next day, I planned on selling those. And I lost money. I lost about $530 on the options because the pop didn't stay up. If you look at it, it barely opened right there at 505 and then fizzled back. And now, it's 458. It's cheaper than where I was. I bought it prior to the earnings. But that after hour session, if you got the cowboy in you, that's wild. That's the Wild West, man, because there's no market maker in there. So you can put a bid in and you can buy it and sell it in the after hours. It's a crazy, crazy time. So that's a really good trick for you if you're looking at that news release.
Hey, Jack, I don't mean to cut you off, but it is 12:32. Fascinating topic. I'm not even sure that everyone realizes the gold that you have given us today. Folks, go back and listen to the recording of the show. Grab the report. I'll post both of those links in just a little bit. But Jack has to run. He is going to be preparing for a presentation at 1 p.m. So in less than half an hour. As a matter of fact, if you stay in this room, you will Jack will come back in less than 30 minutes. It's a presentation for folks that have big accounts, and what we define big accounts as anything $50,000 or greater. Technique you are absolutely going to want to learn. I think some of the most famous investors, won't mention any names, but the ones that tell you just buy an index fund and forget about it, they're doing this technique and telling you to do something else. So you're going to want to listen to this.
That's a good point right there, DA. That's how Wall Street works, not just the elite guy we're referring to that everybody knows. He doesn't even do what he says he does. But all of Wall Street, they tell you one thing and they do another thing. Now, I'm going to tell you what they do and what you should be doing in about 25 minutes almost. So be prepared. Yes, stay in here. Now, let me just answer two questions. Charlie talked about using these patterns in TrendPoint. Absolutely. I use TrendPoint for everything, Charlie. And Penny, you cannot buy or sell options in the after hours, only stocks. All right. That's all I got for you today. I wish we had more time. I could talk about this after hours thing till the cows come home, but I got a really cool thing coming up at the top of the hour. So I got to jump. Adios, amigos.
Thank you so much, Jack. All right. I'm just going to recap for everyone what we've learned today. Jack shared with us a technique that he uses, what he calls how to profit from legal stock market manipulation. I know that sounds very hyperbolic or maybe exaggerated, but the way he tells us is that, hang on one second, folks. I got an alarm going off here. All right. So the way he tells us is that the S&P, quote unquote, rebalances their index every so often, but it's less of a rebalancing and more of a dumping the stocks that aren't performing and bringing on board that stocks that are performing. Now, the interesting thing about bringing stocks on that are performing and dumping the losers is that by dumping the losers and bringing the winners on board, the losers become even more losers and the winners become even bigger winners, because hedge funds and other funds have to match the performance of the S&P, or at least they want to match the performance of the S&P. So they then go out and buy those stocks that were added, and they dump the stocks that were removed. And so the technique that Jack has showed us today is a way of kind of front running that action. As we covered in the show, Airbnb was added, at least it announced that it was added on September 1st. It'll take effect September 18th. I wish I had time to ask Jack this question, but it jumped about 6% on that announcement instantly within 90 minutes. And I'm curious if Jack would have the answer to this, but will that stock continue rising until or through the 18th when it actually gets added? Because I imagine hedge funds are now moving to buy that stock. Of course, New York came out with the announcement yesterday, I believe, or maybe it was Tuesday, that they're going to be putting some some major regulations in place to kind of stymie the growth of Airbnb and similar kinds of companies. So that stock has dropped a bit since then. But I'm curious how this announcement and all those hedge funds moving to buy that stock are going to affect the price between now and September 18th. So keep an eye on it. Maybe paper trade it, see how it would work out for you, and that way you'll know in the future how this thing functions. In the meantime, let's see, we got about 24 minutes until Jack goes live with his big account masterclass. Karen, okay, I'm just looking at the chat here to see if there's any last questions, and Karen says, what's the link for the S&P, please? Yes, thank you for that reminder, Karen. I'm going to drop 2 links in the chat right now. Give me a moment, because I can't seem to type and talk at the same time. All right, so this is how to profit from legal stock manipulation report. All right, so that's the first link I'm going to be dropping there. And that's the report that shows you the technique Jack just talked about. And if you scroll all the way to the bottom of that, it gives the link for the S&P press releases page. If you bookmark that page and just check it every so often, you'll see that I don't think there's any particular schedule at which they do this, but every so often they will announce stocks added to the S&P 500. Once you see that, put them on your radar, or once you get familiar with the technique, maybe buy them instantly, because they seem to jump very, very quickly. All right, so that's that first link that I'm going to drop. Haven't dropped it yet. The second one is going to be weekly spread recordings. Now this is going to have all the recordings from all our past codes. It won't have today's show because I'll have to do that write up and then post it. So later today, if you refresh that second link, you will you'll be able to get the recordings. But for now, I'm going to hit enter. You should see those 2 links in the chat. All right, and I'm going to hand it over to Adam. Adam has now posted the Big Account Masterclass. We've got 22 minutes to go. I'm going to sign off. Thank you, everyone, for joining us. And please sign up for reminders on the weekly spread. It's just jackcartertrading.com/ hold on one moment. Got to find the link for you. jackcartertrading.com/new show. Posting that in the chat. And with that, I'm signing off. Stay in this room, folks. They're going to want to stick around for the Big Account Masterclass. It's a technique that, not mentioning any names, but one of the biggest, most famous grandfatherly investors tells you to just buy an index fund and forget about it. But this is one of the techniques he's doing himself. So the case of do what I say, not what I do, but maybe stick around and find out what he's doing. See you next week.